If you've ever heard the term offshore investing, you've probably also heard a lot of confusion around it. Some people think it's illegal, others think it's only for billionaires hiding money in secret island accounts, and many investors simply avoid the topic because they're worried about taxes, compliance, or getting into legal trouble. But here's the truth. Offshore investing itself is completely legal for US citizens when it's done correctly and transparently. In fact, many large corporations, hedge funds, and high net worth investors legally use offshore strategies as part of diversified global portfolios. However, there is a big difference between legal offshore investing and illegal tax evasion. Understanding that difference is absolutely critical. So, in this guide, we're going to break down how offshore investing works, what the laws are for US investors, the risks you must avoid, and how to stay fully compliant with US tax regulations. If you're interested in global diversification or protecting your assets while following the law, this guide will give you a clear roadmap. Before we start, a quick note. This video is for educational purposes only and should not be considered legal or financial advice. Always consult a qualified tax professional or attorney before making investment decisions. Now let's start with the first question most people ask. What exactly is offshore investing? Offshore investing simply means holding investments outside your home country, usually in another financial jurisdiction. This might include things like international brokerage accounts, foreign real estate, global investment funds, or even bank accounts located in another country. For example, a US investor might buy shares of a global ETF listed in Europe, open an investment account in Singapore, or invest in property in Portugal. These types of investments are considered offshore because they are located outside the United States. But here's an important point that many beginners misunderstand. Offshore investing does not mean avoiding taxes. U.S. citizens are taxed on their worldwide income, regardless of where their investments are located. That means even if your investment is held overseas, you're still required to report earnings to the IRS. This is where compliance becomes extremely important. The United States has strict financial reporting laws for foreign accounts. Two of the most important rules you need to understand are FBAR reporting and FATCA compliance. FBAR stands for Foreign Bank Account Report. If a U.S. citizen has foreign financial accounts whose combined value exceeds $10,000 at any point during the year, they must report those accounts to the U.S. Treasury using FinCEN Form 11-4. This doesn't mean you owe additional tax automatically. It simply means the government wants transparency about offshore accounts. The second rule is FATCA, which stands for Foreign Account Tax Compliance Act. FATCA requires foreign financial institutions to report information about accounts held by U.S. citizens. In simple terms, hiding money offshore is extremely difficult today. Global banking transparency has increased dramatically over the last decade. But again, that doesn't mean offshore investing is illegal. It simply means everything must be properly disclosed and reported. Now that we understand the legal framework, let's talk about why investors still choose offshore strategies. The biggest reason is global diversification. Imagine your entire investment portfolio is concentrated in one country. If that country experiences economic slowdown, regulatory changes, or currency depreciation, your entire portfolio could be affected. By investing internationally, you spread risk across multiple economies. For example, many investors hold U.S. stocks, but they also allocate part of their portfolio to European markets, Asian growth companies, or emerging economies. This diversification can potentially reduce long-term risk and create additional growth opportunities. Another reason investors look offshore is currency diversification. If all your assets are denominated in one currency, you're exposed to currency risk. Some investors choose to hold assets in other currencies to hedge against long-term currency fluctuations. A third reason is access to international markets. Certain industries or high-growth companies may be listed outside the U.S. For instance, some technology firms, energy companies, or emerging market investments may only be available through foreign exchanges. However, offshore investing also comes with real risks that investors must understand. The first risk is regulatory complexity. Foreign investments can involve different tax rules, reporting requirements, and legal structures. Without proper guidance, investors might accidentally violate reporting rules. The second risk is jurisdiction risk. Different countries countries have different legal protections for investors. Some jurisdictions have strong financial regulations and investor protections, while others may have weaker legal frameworks. That's why experienced investors carefully evaluate the financial stability, regulatory transparency, and reputation of a jurisdiction before investing. The third risk is higher compliance costs. Working with international investments often requires specialized accountants, tax professionals, or attorneys who understand cross border financial laws. While this adds cost, it's often necessary to ensure everything remains compliant with U.S. regulations. Now let's talk about a few common legal offshore investment structures that investors sometimes use. One structure is a foreign brokerage account. Many global financial institutions allow international investing while still complying with U.S. tax laws. Another structure, sometimes used by international investors, is a foreign holding company or investment entity. However, these structures can be complex and are usually only appropriate for high net worth investors with professional legal guidance. There are also international mutual funds and global ETFs, which can provide international exposure without the complexity of managing direct offshore accounts. In fact, for many retail investors, international ETFs listed in the United States may be the simplest and most tax-efficient way to gain global exposure. Now let's discuss the most important rule when it comes to offshore investing. Transparency is everything. The difference between legal investing and illegal tax evasion usually comes down to disclosure and reporting. If an investor reports all income, files the required forms, and follows IRS regulations, offshore investing can be perfectly legal. But failing to disclose foreign accounts or intentionally hiding income can result in severe penalties, including large fines and even criminal charges in extreme cases. This is why professional advice is extremely valuable when dealing with international assets. A qualified tax attorney, CPA, or financial advisor who specializes in international finance can help ensure that all reporting requirements are met and that your investment structure remains compliant with U.S. regulations. So, if you're considering offshore investing, here are a few practical guidelines. First, always prioritize reputable financial institutions and jurisdictions. Second, maintain complete financial records and documentation. Third, ensure that all foreign accounts and income are properly reported. And fourth, consult professionals before implementing complex structures. When done responsibly, offshore investing can be a part of a broader global diversification strategy, helping investors access international markets while staying fully compliant. If you've ever heard the term offshore investing, you've probably also heard a lot of confusion around it. Some people think it's illegal, others think it's only for billionaires hiding money in secret island accounts, and many investors simply avoid the topic because they're worried about taxes, compliance, or getting into legal trouble. But here's the truth. Offshore investing itself is completely legal for U.S. citizens when it's done correctly and transparently. In fact, many large corporations, hedge funds, and high net worth investors legally use offshore strategies as part of diversified global portfolios. However, there is a big difference between legal offshore investing and illegal tax evasion. Understanding that difference is absolutely critical. So in this guide,